Thanks for joining us on Balance. This is Bloomberg Quint. I'm Harsha Subramaniam. The headlines at this hour. Nifty crosses 10,750 for the first time ever, led by bank and metal counters. Auto companies missed the bus. Union Bank invites bids for its exposure to SR Steel and Bhushan Steel amounting to 2,700 crore. Lower food prices helps December wholesale price index come in lower than estimates at 3.5%, 3.58% to be precise. All right, let's do a quick check on how the markets are faring. Neeraj is here as always. And it's been good going for the markets today, and you can't complain at all.
No, you shouldn't complain at all, considering the fact that while we had a good handover, it's just that some individual heavyweights are contributing so well. So look at the Nifty Bank, and it tells you the story of the day today. It's financials which are participating. So ICICI Bank up about 2.5%, 3% odd. I think HDFC is making its presence felt in a big way. That's about a 5.5% move on the big boy. This is heavyweight, and it's certainly moving like a heavyweight in the session today. So big going out there for HDFC. Not that the other groups are participating, but the fundraising for HDFC leads to this. Now, just keep in mind, the similar thing would happen at some point of time in HDFC Bank as well. So the smart investor would now start looking at HDFC Bank in lieu of its fundraising. 2% higher for HDFC Bank as well. So some bit of upside already created. But this is what will happen. Financial companies, fundraising happens, book value goes down. People go out and try to maintain the book value, and some buying would happen. So the same thing could happen with HDFC Bank a bit later on. Already started. And by the way, while a clutch of other names will be moving around, and we'll talk about, Emphasis is up about 5% and a couple of others. I think those steel pellet beneficiaries, pellet price beneficiaries, the likes of Godari Power Ispat, the likes of Prakash Industries, and somebody in Bharat Ventures, if I'm not wrong, a clutch of those names seem to be doing real well. Prakash Industries is now up 17%, 10 million shares on that one. Now Bharat Ventures about 3.5% as well. So that clutch of metal and metal related names seems to be doing really, really well. But no taking away that financials are at the peak right now.
Any word on Capital First IDFC?
Yeah, so they've done well. The only thing is, I think where the market probably was or where a few people went wrong is people anticipated that a 12% valuation differential in Capital First would mean Capital First would be the one which will move up 12%, but the differential had to narrow down. So IDFC Bank has come off 3%, Capital First is about, now just about 3%, was at up 5%. So that kind of killed the differential in a different way, wherein IDFC Bank too came off. I think the reason also being both IDFC Bank and Capital First, to be fair, have run up 15% ahead of the announcement. So now there's some bit of a pullback. Had this deal come out of the blue, Harsha, you would have probably seen Capital First zooming up 10% and staying right there. It's following on a back of a 15% rally that we have this stock up of another 3%.
Fair enough. That's an interesting deal today. Neeraj, thank you for that. ICICI Bank, meanwhile, is among the top Nifty gainers today after Morgan Stanley added the private sector lender to its Asian banks model portfolio. This also increases the weightage of Indian banks in the brokerage house's portfolio. Darshan is standing by with the details of why this bullish call on ICICI by Morgan. Darshan.
Yeah, Harsha, so 7.5% is the weightage that Morgan Stanley has given ICICI Bank. Initially, it was 0% weightage. They had the other four banks. So now ICICI Bank comes in. And as far as your question on India is concerned, now it becomes the second largest weightage in the Asia-Pacific market after China. Now, basically what they're saying is the fact that, a lot of these large corporates, lenders are going through a balance sheet cleanup. And the ROE normalization over the next 3-4 quarters will drive stock performance for these bankers. And they're saying across the banks, ICICI Bank currently, because of its price, offers the best risk-reward ratio. They're saying that NPLs as well as profitability issues have been there for multiple years for the banks, and pretty much the cleanup should happen. And ICICI Bank impaired loans are coming off faster than Axis Bank and SBI, and that is why it is preferring ICICI Bank. Valuations, according to them, is attractive, 1.3 times book, and ownership is also lower than the recent history, implying the catch-up will clearly happen for ICICI Bank. Now, in the model portfolio, if you're looking at it, India's weight increases from 20% to 25% because of the inclusion of ICICI Bank. And as far as the entire inclusion is concerned, India is now 25%, only next to China, which is 32%. Earlier, it was at par with Hong Kong at 20%.
Darshan, thank you for that. Union Bank, meanwhile, has put out advertisements inviting bids for two of its stressed accounts. The public sector lender, which made a provision of more than 3,500 crore in the second quarter, wants to sell its exposure to steel companies. Vishwanath Nair joins us with details of who these accounts are, what's the total outstanding amount, and what's the plan. Vishwanath.
So what we understand from the notification on the Union Bank website is that the bank is trying to sell its exposure in SR Steel and Bhushan Steel. SR Steel, it's about a little over 1,500 crore. In case of Bhushan Steel, it's a little over 1,100 crore. This is important because this is prior to how the potential bidders are going to bid for SR Steel on the 29th of January. That is when the last date for the submission of bid is. So before that, there has been some dynamic shift in how banks have their exposures planned in SR Steel. What will happen essentially is that some of the existing lenders will take over these exposures and will try and solidify their position, have more say in whenever the submission of the bids happen, and then they will be able to take a call on whose bids will qualify for SR Steel as well as Bhushan Steel. In December, we saw banks like Axis Bank and Bank of Baroda who were able to sell their foreign currency exposures in SR Steel. Similarly, Indian Overseas Bank, which is one of the more sicker banks among the public sector banking segment, they sold about 600 odd crore in Bhushan Steel. So these are some of the shifting dynamics that we are seeing in these insolvency cases.
Vishy, thank you for that. IDFC Bank-Capital First, the big story of the day, announced their merger of their operations. Shareholders of Capital First will get 139 shares of IDFC Bank for every 10 shares held. The result, a lender with a portfolio diversified across large corporate, small and medium-sized enterprise loans, and of course retail credit. Shraddha is standing by with the deal synergies, and what do shareholders really gain out of this merger? Shraddha.
Well, just to start off with, just want to say that analysts broadly do believe that it's a better fit for IDFC Bank than Shriram, and largely there is no ambiguity with respect to the deal going through, and the kind of structure, the deal structure is a lot more cleaner. Now, having said that, let's just look at the matrix of who is going to get what. Now, for HDFC Bank, this was important because they will get the much coveted retail loan book that they really needed. They'll have a retail and MSME customer base to whom they can sell their deposit products and build that retail liability franchise. And then they also get a team which understands retail banking. So V. Vaidyanathan will be heading this bank, and he has been a veteran in the retail banking space. So that's as far as IDFC Bank is concerned. For Capital First, they will have a retail corporate book balance. So currently the retail book stands at about 93% or so. Now the retail upcycle is something that we have seen, but eventually when the capex cycle picks up and demands for corporate loans pick up, as an entity together, they will probably be in a better position to be able to cater to both the retail and the corporate cycle. There is a potential to raise low-cost deposits. Currently, Capital First doesn't get much because IDFC Bank's CASA share stands at a low of 8%, and they will get a universal banking platform. So broadly, the combined entity could, as it stands today, have a wholesale loan book of about 50,000 crores and a retail SME book of 40,000 crores. As far as the gross NPA number is concerned, it could improve given that Capital First's gross NPA ratio is much lower at 1.6%. But the caveat here really is that its SME book hasn't really been tested in a down cycle. Having said that, what is going to be more important, or the bigger point here, is the kind of landscape that this merged entity will actually be exposed to and will have to compete in. So you have 21 PSU banks, 15 private banks which will be competing. When it comes to PSU banks also, at least there's a belief that post adequate capitalization, now PSU banks will also be back into the game, at least the larger, more stronger capitalized ones. You have 10 small finance banks and 33 NBFCs. So the whole point here being that it's going to be, it's not going to be easy to be able to differentiate and build that kind of a liability franchise. Having said that, Yes Bank and Kotak Bank have had some success in doing that. So the merged entity, IDFC Capital First, could have a retail. As of now, the merged book would mean a retail share of about 35%, but you have seen those kind of numbers even for the likes of Yes and Kotak. Lastly, just a word on what the post-merger shareholding pattern could look like. Warburg Pincus, their stake will come down from 33% in Capital First right now to about close to 10% in the merged entity, and IDFC's stake in the merged entity, that's the third chart that we're talking about, will actually come down from about 52% to close to 37.6%. So they will have to go ahead and raise or bring up their stake to about 40%, for which they'll have to invest a smaller amount. But largely a win-win deal, but it's going to be a tough road ahead.
Shraddha, thank you for that. Well, and Capital First founder Vaidyanathan says the deal will only help him achieve the target of moving out of the NBFC space and become a full-fledged bank. Ira spoke to both Vaidyanathan and with Rajiv Lal to talk about the synergies and a stronger presence across platforms. In fact, Ira started off by asking Rajiv Lal, the CEO and MD of IDFC Bank, on whether this deal is a much-needed one when compared to its failed attempt with Shriram Capital. Listen to this conversation.
It's a much easier transaction because it involves only the bank and Capital First. The strategic synergies, I think, complementarities are very clear. Our stated goal has been aggressive retailization. This merger brings that and more. 3 million customers, branch footprint, retail asset book, with a focus on a particularly interesting customer base, which is harder for banks to access. That's another important feature of the strategic fit. Then from culturally, this is extremely important. I think trust between us, general cultural fit between the two organizations, limited overlap in terms of people. That's the second big leg of it. And then from the third aspect of this is that if you look at it from IDFC bank shareholders' point of view, they will end up owning 72% of the combined entity. We believe that the control premium that this transaction entails is actually quite modest relative to recent transactions. Kotak paid 21.5% control premium for the transaction they did. This is much more modest than that. And from a regulatory perspective, remember that IDFC shareholders are obliged to reduce their shareholding in the bank from 54 to 40% by October 2018. So timing of this is really quite crucial because there's no sense in our raising primary capital between now and then. It would have meant that IDFC shareholders would have had to shed stock in the market. That would have not been constructive for the share price, and therefore this is a very elegant way for IDFC to also meet its regulatory obligations. So on multiple fronts, this just seems to make sense.
Absolutely. Mr. Vaidyanathan, now, Dr. Lal has spoken publicly about, the need to expand retail base of the bank. He's spoken about, inorganic being an optional route, perhaps a preferred route. In your case, I know at the back of your mind, there may have been that desire to be a bank, but you were growing very well. As an NBFC, you've had a very, very strong, sort of growth path. Why did you feel the need to do this right now? You could have potentially waited until your book was, 50,000 crore or more than that.
Probably more.
Yeah.
So when we started, we had a loan book of just about 94 crores in retail.
Yeah.
So we felt that growing from there to about 25,000 crores, in the initial stage, when our book was growing from 20 to maybe 15 or 16,000 crores, there was real funding challenges because they were small NBFC. In the last 3 years, those funding challenges have vanished because companies become large. Now from here to about 60, 70,000 crore, of course we could have pulled staying in NBFC, life would have been fine. But at some stage, if we got to make an eternal organization, then we have to be a bank because the liability base has to be diversified and has to be stable. It doesn't matter it's low cost, of course it's a big bonus, but it has to be more diversified than being low cost. So that was a key need. So that need could have waited 5 years. But then it doesn't mean that at the end of 5th year, I got a great opportunity like this sitting on me. So sometimes, a good relationship comes by, just strike it, don't really wait for the best timing.
Okay, since you've gotten into the liabilities conversation, let me get straight into that. Dr. Lal, I asked you this at the last merger time as well. Should the liabilities base not come before the asset base? You said that it should be reverse.
Yeah,
but I mean,
let me reiterate the argument that how do you, so aggregating liabilities is a long-term task. It takes time to do it. It's a marathon business. He incidentally is a marathon runner. But jokes aside, it takes time. It cannot be done overnight. How do you acquire liabilities? You acquire liabilities, you can do it independently of assets, but from a customer point of view, they want a holistic relationship with whoever's their bank. So the strategic bet calculus that we are making is that the resources required to actually build that liabilities franchise will be generated by retailizing the balance sheet, acquiring the customers to whom you can cross-sell liabilities, develop a more wholesome relationship with them, a more long-lasting one, at an accelerated pace. That's been our view. Just theoretically, as a counterfactual, acquire a liabilities base. What does that mean? It means a bank. Now, banks are not just hanging off trees that we can go pick one and say, yeah, this is great, give me my liabilities.
Quite a few banks, but I'll come to that later.
No, so let's not delve too deeply into that. You know what I'm saying. Culture, chemistry, people, there's so many other things involved in making an M&A transaction work. As Vedya said, relationships don't come by that easily, and we learn by experience. This one we grabbed.
There were a few hanging on the tree actually at the point of time.
What was hanging on the tree? Potential opposite.
There were a few banks hanging.
For you or for him?
For us, and we were looking here and there, but then at the back of our mind, we never said it. I said it publicly also that we want to be a bank.
You did.
I did, and it's been maybe since 3 years I've been saying it without being shy. No, I'm fine as an NBFC. I can pull on forever. I never took that line. I said I want to be a bank. Now, there was some there in the horizon. And
banks, huh? You want to name any of them? Now that the deal is done, I'm happy to hear.
I'll hold it for another day. But they were there, and thinking about talking to them, or even talk to some of those, key shareholders. But then, when this proposition came along between the two of us, I felt this is a very good fit because this is a very good bank. It's got very good people, it's got a very good culture, it's got a banking license, it's got a 2-year head start. I really like this bank. So when you put that and then you say, okay, we've got capabilities, they've got the banking license, put them together and we have a bank. And the key idea is to say, it's just not about adding value to capital for shareholders. It's not the objective alone. How to add value to IDFC Bank shareholders. And I think we can really bring a lot of value when we put the pieces together and grow the bank together over the next 10 years.
Okay, that's Vaidyanathan and Rajiv Lal talking about the synergies of the merger. Let's move on and give you some macro news. Wholesale price inflation for the month of December came in at 3.58% against a Bloomberg consensus estimate of 4%. This compares to the 3.93% reported in November. The fall in inflation was led by food inflation that stood at 2.91% versus 4.1%. Primary articles at 3.68%, or rather 3.86% versus 5.2%. Fuel and power prices, however, surged 9.16% versus 8.82% in November. Core WPI inflation stood at 3.1% as against 3% last month. The WPI data marks a stark divergence to the retail inflation trend. CPI inflation surged to 5.21% in December against the 4.8% level seen in the month of November. All right, let's move on. In his 2004 Union Budget speech, the then Finance Minister P. Chidambaram abolished the long-term capital gains tax on listed equity. The effective rate went from 10% to 0. Every year since then, the issue of reinstating the tax pops up before every union budget. Now the controversy is back, and it's anybody's guess if Budget 2018 will bring back the long-term capital gains tax. Menaka Doshi caught up with Pranav Sehta, a tax advisor, tax partner at EY, and Ketan Dalal, managing partner at Catalyst Advisors, to discuss the pros and cons of long-term capital gains tax. And we had a divided panel. So listen into this slice of this conversation.
This regime has stood the test of time. The government introduced it with a very clear ideology of trying to have a securities transaction tax, continued for so many years. There is a simplicity to it. There is a certain element of tax without whether there is profit or loss, and this has stood the test for a long, long time. That being the case, I think it should be continued. Stability, predictability, lack of uncertainty is a big thing from a tax standpoint, and I would think that this uncertainty should be put to an end, and one should either take a stand one way or the other, but I would think in favor of stability and in favor of STT versus a long-term capital gains tax is what they should go with.
Now, Mr. Dalal, do you really think it's a debate between STT and long-term capital gains tax?
So I think, Menka, I have a slightly different take from what Pranav said. I understand the stability, etc. part, but I think there is a case from an equity standpoint, and pardon the pun, from an equitable standpoint, there is a case for at least some kind of a concessional rate, if you will, on long-term capital gains. It may not be the full rate, but it should be some kind of concessional rate. I think also we have to look at it from a larger perspective. And the larger perspective is, I think the other rates need to be brought down. You cannot have a long-term capital gains and the rates which have been promised to be brought down from a long time, and we currently have them at 35%. You had those rates at 31% in 2010. 8 years later, the rates have gone up because surcharges and cesses have gone up. But on the long-term capital gain itself, Menka, I think there is a case to bring it there. I mean, for example, China has 20%. Maybe what you can do is to have the smaller investors exempt, given the fact that there is a lower equity penetration from small investors. So you can say, for example, that somebody who makes a gain of up to 2 lakhs or 3 lakhs a year on long-term capital gains will be exempt, because that will also encourage and incentivize the equity penetration. But over and above that, maybe at some graded scale, I think there is a case to bring it back.
Okay, let's see, Mr. Dalal, if we can convince Pranav with that. Do you believe that if it were to be brought back, but the smaller guy would be exempted from it, and maybe the better way to do that is to link it to your tax slab,
Sure.
Saying that, okay, if you are in the 30% slab, then you pay X% on LTCG, as opposed to link it to the quantum of gains in itself. Because, a big guy may make a small amount of gain in a particular year for a variety of reasons, but that still might be something that's tax worthy. So do you think if it were to come back, and if it were to come back only on the rich fellows, if I may call it that, then that might be something that you're okay with?
Okay, so let's put it this way. There are merits to a long-term capital gains tax, and one of the chief merits is bringing down inequalities of income, if I might say so.
Revenue collection in a year.
And ensuring,
when you're really nervous about revenue collection.
For sure. So I'm not too sure how much long-term capital gains tax is going to contribute to that particular kitty. With service, and I assume that when long-term capital gains tax does come, it will mean repeal of the STT. Because otherwise it would be a double whammy.
Or a set-off. Or a set-off. Can you do that?
I'm not too sure of a set-off, because if I suffer a loss, I still pay STT. If I don't make a gain, I still pay STT, and there could be different things in different years.
Maybe you could carry forward your STT payment towards
the gain. Yeah, so I'm only trying to complicate the tax even more, and I'm not too sure that's going to achieve much of a purpose, because at the end of the day, we are talking of two alternative tax regimes, either a tax on my total sale price or purchase price, as the case may be, paid once and for all, no questions asked, simple, stable. It has continued for so many years. I don't need to maintain details of my cost of acquisition, year of acquisition, date of acquisition. It saves so much tax, so much time from a tax effort from a taxpayer standpoint, saves so much time from a tax administration standpoint, and I'm not too sure an analysis is done of how much they are going to collect by way of capital gains.
Mr. Dalal, do you think this really will impact, as they put it, foreign investor sentiment when it comes to the Indian equity markets? Because, there are two things here. One is that all I've ever heard you and Pranav and all other tax experts and all other FIIs saying, hey, look, we don't mind paying taxes as long as you make it predictable and stable. The second thing is that we saw big changes happen to the Mauritius and Singapore treaties, and now commensurate changes happening to all the other treaties that India has, tax treaties that is, and it didn't change the FII sentiment in any dramatic fashion. They're not making decisions based on that as long as they know what the tax architecture is. So do you think this could have an impact on FII participation?
Yeah. My sense is, Menka, that it will have limited impact. If you look at the foreign investors on the stock market, I would divide them into two baskets, the FIIs on the one hand and the private equity on the other. The private equity are usually not trading, so to speak, or churning the portfolio obviously as fast as the FIIs, and FIIs is anyway the major one. You mentioned about Mauritius and Singapore, and while I don't remember the numbers offhand, I think about 60% of the total investments were anyway coming through Mauritius and Singapore, and subject to the grandfathering up to 31st March, the new investments now are liable to tax. If you make an investment after March 17 and sell by March 19, both under India-Singapore or India-Mauritius treaty, you will pay that tax. But of course, if it is long term, you will anyway not pay because of domestic law. Coming back to the question itself, I think the impact will be limited, but I think the tax rate at least should be low, at least in the initial stages. So for example, if it is say 10%, it could be 5 in the first year and 10 in the second year, as opposed to doing everything at one shot. I think that's the way I would look at it. I also want to make one more point. When you look at capital market tax changes, maybe you can also look at the dividend distribution tax, because today what is happening, an investor who borrows money to invest in shares does not get a deduction of interest because dividend is considered to be tax exempt, but it's not, it's economically taxed. But because technically the company pays DDT, you don't get interest deduction. So I think why you may think of bringing long-term capital gain, also make interest deductible. Because you cannot have it one way. I think the point I'm trying to make is it needs a little bit of a holistic look as opposed to a siloed look.
But Mr. Dalal, at
and
a
maybe
time,
even the losses should be allowed to be set off more. Yeah.
No, at a time when revenue is hard to come by, I'm sorry to have interrupted you, but at a time when revenue is hard to come by, and so much of the political pitch is towards equality, and we are going into, an election year very, very soon, giving the guy who borrows money to buy shares or do any of those things, any kind of set off, I'm not even sure how well it will sit with the folks at the finance ministry. I have just one last point to make to Pranav, because I know he started.
No, why?
Go ahead, please go ahead. Mr. Dalal.
No, I think Menka, I don't agree with that point. See, what do you tax on? Profit. If you are borrowing money to invest in shares, the profit is reduced to the extent of the interest. So what should you tax on? The net, right? I mean, I don't see any reason, and I'm not saying there'll be a huge amount of interest deduction, but if you are expecting him to pay on the capital gain, you should at least give him an expense that is related to that gain.
Interesting debates on capital gains tax. As I said, the debate about whether capital gains tax will come back in some form in budget 2018 is back. Let's wait and watch what the finance minister does on the 1st of February. But coming up next, traders expect the rupee rally to fizzle out. We'll tell you why after this little break.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
More than just business news, we're news for business people.
Back on Parlance, let's take a look at the headlines at this hour. Nifty crosses 10,750 for the first time ever, led by banks, metal stocks and auto companies missed the bus. Prospect of turning into a bank clinched the deal with IDFC Bank, says Capital First founder V. Vaidyanathan. That's a done deal. Ford chairman Bill Ford says the automaker will invest $11 billion by 2022 to launch 40 new electric and hybrid cars. That's a Bloomberg exclusive. All right, the markets has been a good day so far. You're seeing stocks across the board run up quite significantly. Pradeep is taking a closer look at some of those stocks that have moved in the last half hour. Pradeep.
So markets in fact opened with a gap up, and then we have been holding on, rather building on those gains. What has also happened is in last session, it was actually an interesting day of trade when markets suddenly collapsed because of that press conference of 4 senior Supreme Court judges. And as we had discussed, that the seasoned traders had in fact gone long and they must have reaped the benefits. But people who were kind of looking for a breakdown to short, and those who shorted at lower level got trapped. So there was a fair bit of short covering also that played a role in today's rise, and looks like now market is kind of hovering at the higher levels for the day, coming off a bit because most of those shorts are probably covered. What is also interesting in today's trade, if you look at stock specific moves, you have your usual suspect high beta names, but also a lot of news driven activity is taking place. You've been looking at IDFC and Capital First, but also HDFC and ICICI Bank, the 2 major stocks that are driving the market, again because of HDFC's fundraising, and ICICI got a upgrade from Morgan Stanley. So that is also playing a part. So if you look at financials per se, there is also some buying interest in insurance that continues since last week, and this remains a very interesting segment. And because financials account for 40% plus weightage in key indices, I think that is what is really driving markets up. But PSUs are not participating at all. The PSU index, if you look at PSU banking index, it's up by just 0.3% when I checked it last. So it's basically private sector banking, rather private sector financials rally that you have, and you'll include Muthoot Capital as one of the key gainers in that trade. The other interesting segment in mid-cap space is the television distribution companies like you have Hathway, Den, which are doing well. Disappointments today is the Syntex Group. Post demerger, there are so many traders and investors who have been holding on to it. This was the second quarterly number of 2 distinct entities that came out, and both the entities have disappointed. So both these stocks are taking a beating in an otherwise rising market. And the other one is Venus Remedies, which has now been declared willful defaulter. So that was down 14% when I checked it last, well close to that level, still trading at.
Pradeep, thank you for that. That's the markets for you. Let's move on now. It's a churn in India's banking sector. On one hand, the government and the RBI's push to clean up the NPMS could bring PSU banks in the game. On the other, consolidation is paving the way for large-sized bank. And at this stage, how should one play the country's banking sector? We asked that question to Dhananjay Sinha, head of research, economist and strategist at MK Global. Listen into that slice of that conversation.
So RBL, I suppose is traded somewhat higher in terms of valuation. So I think with the merged entity, the valuation is somewhat lesser, and with the ability for it to grow, and if the assumptions we'll have to make is that the new management with Mr. Vaidyanathan coming in, I think the possibility of stronger growth will pan out. So for the valuation that is lower than RBL, for instance, I think it's a good bet.
Okay, so it's a good bet. in private sector banking space. That's the call coming in. IDFC Bank will probably see some buying interest on fundamental basis. Just one call on what do you really expect from PSU banking before we move on to other sectors, because people have been expecting bottoming out, or rather topping out NPAs, and therefore kind of bottom in earnings. Do you think this quarterly number, December quarterly number, will actually reflect that, and we'll see upside over next month and a half?
I think it will be premature to actually guess a significant turnaround or price in a significant turnaround for the PSU banking space. We are looking at a scenario where the systemic growth has actually improved, and from that standpoint, if you look at the credit growth for the system, it has improved to something like 11% by end of December. So, and that's a high. That's a high, much higher than 5% by, let's say, March, and so there is an incremental addition in credit, additional momentum in credit growth that is happening. But I suppose this is largely been driven by the private lenders, and the PSU banks, though they will be on a better situation compared to what they were in March, I think they would still be lagging behind. So from a market share standpoint, they might still be losing. Number two thing is that the yield curve has actually steepened, with 10-year yield actually risen to almost like 7.4% or 7.5% now, somewhere in between. So that's contrastingly higher than what we saw in, let's say, mid-2000, somewhere around June, July 2017 at 6.4%. And our view is that a considerable amount of investment or trading gains were made by having a certain position in the GSEC market or GSEC portfolio, and that contributed more than 100% of the profit before tax for many PSU banks. So with the steepening of the yield curve and yields rising, it is possible that they will actually incur losses because of the steepening of the curve and fall in the value of bonds in their portfolio or in the SLR portfolio. Now, whether they will be able to translate operating profit much stronger than the impairment with respect to the trading profit is one thing that we'll have to be watchful of. My own view is that during post the demonetization and subsequently also that PSU banks had increased duration on the GSEC portfolio, and hence the possibility of losses from a trading profit standpoint is something that we'll need to be watchful of, and the operating profit may not be so strong. So that's the whole mix of the operating profit and the trading profit. And the other aspect is with respect to provisioning, etc., and NPA issues. I think that will continue to be there, though on a slow pace. It is possible that slippages might be somewhat lesser, but I think it is important that the recapitalization that has been announced, that is happening gradually, and I think the full partial impact of that will happen possibly in the March quarter.
That's a view from MK Global. Let's move on now. The rupee has gained 1/3% today, extending the currency's stellar rally after it hit the strongest level in 32 months. But don't let that strength fool you, as strategists are expecting this rally to be short-lived. Karthik Goyal of Bloomberg News is here to tell us why. Karthik, thanks for joining in. What's the market reading? Are they expecting these levels to stay, weaken? What is the direction?
Yeah, Harsha, thank you very much. The main thing is that the rupee strength has actually come on the back of a very weak dollar and is not backed by very sound economic fundamentals. And, so that is what is worrying these strategists. So if you see that, India's economic growth is at a 4-year low. We have inflation, which is at a 17-month high. We have current account deficit, which would be higher this year than the last year. And, and to add to all this, we have oil prices just continuously going higher and higher, which would have a very negative impact on India's finances going forward, that the current account and the fiscal deficit. So it's not overall a rosy picture going forward. So if as all these negatives play out going forward, we may see rupee coming under pressure going ahead. Like in 2014-15, when the oil prices crashed, it was called as a manna from heaven for India. That theme is reversing with oil prices at $70 a barrel.
you now have a very important economic event in the budget coming in the early February. In the near term, how about strategists? What kind of levels are they talking about?
So rupee may be on a stronger ground for the timing, but budget will set the tone for the rupee going forward. Everybody is watching what kind of growth boosting measures Prime Minister Modi's government unveils in the budget. Remember, this is the last budget before the 2019 general elections. Budget is likely to be very growth positive. But it would also be very interesting to see how they rein in the budget deficit going forward. It will be quite a difficult balancing job for the government. But definitely, yes, budget will set the tone for the rupee for this year.
Let's get to someone from the market to talk about this. Thanks, Karthik, for that. Bhaskar Panda, Senior Regional Head of Treasury Advisory Group at HDFC Bank, joins us on the phone line. Mr. Panda, thank you so much indeed. What are you making of the strength in the rupee currently? And would you agree with the conversation I was having with my colleague Karthik, is that the factors are not lending support? Would you agree?
Let me tell you, this rupee strength is not coming from only, either crude oil prices or something like that. Let us be very aware that a lot of funds are getting into India even today because of the growth, prospects that we will be having vis-a-vis other countries. Second thing, if you look at, dollar index charts, it's almost broken the last low that we had seen, which was at 90.93 sometime back in Q3 in 2017. And probably next point is, technically speaking, around 89.42. So if it goes there, for example, if I believe that dollar index goes to say 89.42, that means rupee is going to, appreciate against dollar, at least in the short term. Yes, there is a problem in terms of higher oil prices. Therefore, our import demand going up for dollar. However, for the time being, I think it seems that we should be in this rupee appreciation kind of mode, which I feel probably will take towards 63 or probably, if it breaks 63, maybe 62.80. But I feel in the short term, at least I feel it will remain between say 63 to 64 and not move too much beyond these two.
Okay, so some of the people, forecasters who we spoke in the market also sort of acknowledge this turnaround in sentiment. What's your sort of prediction for the currency, post the budget, and how do you think around the budget the currency is likely to behave?
I think, everybody is talking about a populist budget, and everybody is talking about, budget favoring certain section of the people, so on and so forth. But one thing is for sure, everybody is aware that whatever comes in the budget will be growth-oriented. I think if that remains a focus in the budget, obviously you will have positivity for both Indian stocks as well as, Indian rupee. If you look at Indian rupee also in context with other emerging currencies, including China also, we're, almost there with those guys. So we have not really broken ranks with these kind of, other competing currencies. So therefore, I think it's fine. It should be okay, in my opinion.
One final question, sir. So what is the data point that you're looking for? What will define the trajectory of the rupee going forward? Would this be about the deficit numbers that come out around the budget? Would this be about inflation numbers? What's going to be influencing the influencing factor?
I think both are complementary, isn't it? If your deficit goes up, obviously it will impact inflation as well. So both are, if we are going to break the deficit figures, then that will be a negative news in terms of, other agencies keeping a watch on India. However, I think there is no sacrosanct, you have to keep a certain number in view. So in that sense, I think it will have lesser impact on dollar rupee rather than on probably your, G6 or their yields on that. So I find dollar rupee to be little immune to budget, but at the same time, obviously higher oil prices will have a negative impact in the longer term.
So one final point, sir. The way the US dollar has been behaving, it's been continuously weakening against most currencies. Do you anticipate that to continue again? Most strategists believe that you're going to see the dollar weaken. Is that sort of the overriding theme of 2018?
I think first half, yes. Second half, we don't know. I mean, there are so many things which is going to happen. One is, U.S. interest rate is definitely going to go higher. I don't know how many, but at least 3 hikes I'm expecting. Employment scenario looks okay. So maybe beyond a point, if you look at it, it won't go below beyond a point. Even if we see it technically also in the last rally which happened between say 2014 to 2015, 16 high, around that the 50% of the FIBO would come somewhere around 89. My feeling is that it is not going to break below that.
Mr. Panda, we'll leave it there. Thank you so much indeed for taking our call. That's a view of HDFC Bank on the rupee, on where the currency is headed. Don't get fooled by the near-term strength. There's weakness in store is the view of the market. Well, it's not just the currency. The commodity markets have also seen a stellar start to 2018. Brent hovers around 69 to the dollar mark. WTI or crude is about 64 to the dollar. Fatih Birol of the International Energy Agency, or the IAEA, does not see a significant upside to oil prices. Speaking to Bloomberg at the Atlantic Council for Global Energy Forum, Birol expects that oil markets to remain balanced for the rest of the year. Listen.
Oil price is about $70. And when we look at the year 2018, in the next 12 months, we see more or less a balanced market. The global oil demand will increase about 1.3, 1.4 million barrels per day. But a lot of new oil production is coming from United States, from Brazil, from west of Africa, from Canada, and to put a lot of oil in the market. So as a result of that, we expect a balanced market in the next 12 months to come, unless we have some surprises.
And how do you think that will impact the prices?
I think the prices, without the surprises, geopolitical or a supply disruption type of surprises, we think the prices were more or less in line with what we have been experiencing in the last few months.
So you don't see any, I mean, do you see the current, there has been already a lot of talk that 70 is the top that the prices will reach. Do you agree with that?
It depends on what happens in the markets. If it is only the supply-demand current picture, I don't expect huge increase of the prices. But I can highlight 2 important potential surprises. One of them is Venezuela. Currently, the decline in the Venezuelan oil production in a very short period of time is the biggest decline in the history of oil since 30 years as an unplanned decline. It's huge. And this decline may well go further, and this is a major potential surprise. What will happen with Venezuela? Other surprise, and this is an upward surprise, an upbeat surprise from the United States. The $70 may be seen as a very good news in, for example, in Gulf, in the Middle East, but the $70 may well give an additional incentive to shale oil in the United States, so the U.S. oil production may grow higher than what we assume today. So on the supply side, therefore, I see 2 surprises, potential surprises, I should say. One, Venezuela may well be much lower than what we think today, and U.S. may well be significantly higher than what we think today. These are the 2 potential surprises I would highlight.
That's Fatih Birol. Let's also get across live to Prime Minister Modi and Prime Minister Netanyahu addressing the media after bilateral talks. Listen in.
Great pleasure to welcome Prime Minister Benjamin Netanyahu on his first ever visit to India. Yedidi Hayakar Baruchim Baruchim Havayam Le Hod. My good friend, welcome to India. Your visit, Prime Minister, is a long anticipated moment in the journey of friendship between India and Israel. Your visit is also a fitting climax to the commemoration of 25th year of diplomatic relations between India and Israel. As our first honored guest in 2018, your visit marks a special beginning to our New Year calendar. It comes at an especially auspicious time as people are all over India are rejoicing the arrival of spring, renewal hope, and harvest. The festivals of Lohri, Bihu, Makar Sankranti, and Pongal celebrate the splendor of India's diversity and unity. Friends, last year in July, I carried the greetings and friendship of 1.25 billion Indians during my momentous journey to Israel. In return, I was overwhelmed by the generous affection and warmth of the Israeli people led by my friend Bibi. In that visit, Prime Minister Netanyahu and I promised each other and our people to build a strategic partnership of hope and trust and progress, of diverse and cutting-edge cooperation, and of joint endeavors and shared successes. Such a promise flows as much from the natural affinity and friendship that have linked us for centuries, and it does from the compelling win-win case for engagement in almost all spheres. And it is a measure of our shared ambition and commitment that 6 short months after that visit, your extraordinary visit is taking place to India. Today and yesterday, Prime Minister Netanyahu and I reviewed the progress in our relations and renewed our conversation on the possibilities and the opportunities that beckon us and need to be seized. Our discussions were wide-ranging and intensive. They were marked by the desire to do more. Prime Minister, I have a reputation of being impatient in getting results. If I may let out an open secret, I know that so are you. Last year in Tel Aviv, you had expressed the intent to cut down bureaucratic red tape with a machete and forge ahead with speed. Prime Minister, I am happy to tell you that in India, we are well on our way to doing just that. We have imparted our shared impatience to the implementation of our earlier decisions. The results are already visible on the ground. Our discussions today were marked by convergence to accelerate our engagement and to scale up our partnership. We will pursue this in 3 ways. First, we will strengthen the existing pillars of cooperation in areas that touch the lives of our people. These are agriculture, science and technology, and security. We exchange views on scaling up the centers of excellence that have been a mainstay of agriculture cooperation by bringing in advanced Israeli practices and technology. In defense, I have invited Israeli companies to take advantage of the liberalized FDI regime to make more in India with our companies. Second, we are venturing into less explored areas of cooperation such as oil and gas, cyber security, films, and startups. You will find this reflected in the agreements that we are just exchanged. Several of these areas are indicative of our desire to diversify and broad-based engagement. And third, we are committed to facilitate the flow of people and ideas between our geographies. It requires policy, facilitation, infrastructure, and connectivity links, and fostering constituency of support beyond government. We are working with Israel to make it easier for our people to work and visit each other's countries, including for longer work durations. To bring people closer on both sides, an Indian Cultural Center will soon open in Israel. We have also decided to start an annual exchange of bilateral visits by 100 young people from science-related educational streams.